Hello, everyone, and welcome to our brief overview of the revenue cycle. Today's goal is to introduce you to the key steps a company takes to sell products or services and collect cash from customers. So let's get started at the very beginning. So what is the revenue cycle? The revenue cycle, sometimes also called order to cash, is simply the set of activities a business follows when a customer buys something. It starts when the customer places an order and ends when the business receives payment and deposits the cash. As auditors, understanding this flow is crucial because any error or fraud in these steps directly affects a company's reported revenue and cash balances. And we know that in auditing, if there's a material misstatement, we need to be able to find and document that. So what happens in this cycle? So we have really 5 key areas of what's going on in this cycle. So I want to talk about each of these and also the documentation that we would expect to have at each of these cycles, or each of these parts of the cycle. So in the very beginning, the customer is going to place an order, and also we would like to see that customer's credit checked to make sure that we are selling goods to good credit quality customers. So in this process, first, a customer is going to tell the company what they want to buy. This typically is going to come in the form of a sales order. They may also call it a purchase order. Just that initial documentation showing what the customer is requesting and the quantities and the price that they have agreed to pay. That's the first proof that a sale has started. Then we move into the shipment of goods. Here, once credit is approved, the company is going to ship or deliver the goods and perform the services to the client based on what they had ordered in step 1. Some of the documentation we would like to have here are the shipping documents, also called the bill of lading. So when the goods leave the warehouse, some sort of shipping document should be prepared to show what items went out, when they went out, who picked them, who sent them. This is the proof that the delivery actually happened. Then we move into step 3. So after those goods are shipped, we then would bill the customer for the amounts that they owe us. This may also be called invoicing. So after the shipment has been completed or after the services have been rendered, the company is going to send an invoice or a formal bill to that customer listing what they owe. This needs to happen after shipment. So we know that cutoff is a major concern. And if we are invoicing before shipment, that's a big no-no. So we want to make sure that this invoicing takes place after the goods have been shipped. Then we move into recording in accounts receivable. So the company is going to record that invoice in its accounting system under accounts receivable to show that that customer owes us money. Then in step 5, we have the customer is going to pay our bill or pay their bill. And we talked about this briefly in chapter 6 when we were talking about cash receipts. But essentially, when the customer pays, the business is going to deposit that cash in the bank and clear out the accounts receivable entry to show that they no longer owe that money. Some important documentation here, the remittance advice. Remember, that's the little slip of paper that if they send in a check that's going to come in and indicate what invoice that they are paying. And then the deposit slip proves that the cash actually was deposited into the bank. So that is a very brief overview of what is happening in this cycle.